Latin America, after record tightening, could lead way on rate cuts. Latin America's major central banks, which have led some of the most aggressive tightening over the last 2 years, may now be poised to lead the world on interest rate cutting amid clear signs of slowing inflation in places like Chile and Brazil. Potential key inflection point comes even as the U.S. Federal Reserve and the European Central Bank both signal further interest rate hikes may be on the horizon, and the Bank of England surprised many investors by hiking interest rates 0.5 percentage point last week. Latin America embarked in early 2021 on one of the world's sharpest monetary tightening cycles to contain runaway inflation fueled by bottlenecks in the global production chain, rising food prices, and the spillover effects of fiscal stimulus measures used to ease the economic pain of the COVID-19 pandemic. That's meant rates are already sky-high 11.25% in Chile and Mexico, and 13.75% in Brazil, with more room to cut. We expect Latin American central banks to be the first to cut rates globally because there are various domestic dynamics that have benefited the region. Goldman Sachs notes that the region was seeing gradual but steady and broadening progress on inflation, including core prices, that could signal a policy pivot ahead, albeit with caution. Central banks will be looking for signs of disinflation consolidation and macro rebalancing before starting to credibly reduce the level of monetary policy restrictiveness. The small South American country of Uruguay has already cut rates, by 25 basis points in April. Chile is seen easing as soon as next month, with Brazil potentially following close behind. Chile's central bank kept its key interest rate on hold at 11.25% last week, but said if recent positive trends continue, it could begin cutting the rate in the short term. The market has already priced in the expectation of a 100 basis point cut. In regional powerhouse Brazil, the central bank held rates steady last Wednesday for a 7th straight time, though it took a more dovish tone on future steps by excluding the possibility of upcoming rate hikes from its policy statement. Brazilian financial markets showed many traders are betting the bank will kick off a cycle of monetary easing in August, as President Luiz Inácio Lula da Silva again called on the monetary authority to cut rates to spur growth. Mexico looks further behind. Its central bank kept the rate steady last week for a second straight meeting, signaling it will hold the rate for an extended period, despite consumer price inflation at its lowest in more than 2 years. This, alongside hawkish noises from the Fed, mean that Mexico is unlikely to shift towards rate cuts until the turn of the year. Peru's central bank, however, which has kept its benchmark interest rate at 7.75% for 5 consecutive meetings, is seen likely cutting rates in August. In Colombia, the central bank's board is expected to hold the interest rate steady at 13.25% at its next meeting on the back of a better inflation outlook, ending nearly 2 years of rate rises aimed at containing rising consumer prices. Colombia and Mexico will be the last ones to cut rates, possibly in the fourth quarter.